All right, welcome to the April investment outlook from Sygnum Bank. Thanks once again for joining us. My name is Lutz Preussler. I'm responsible for the asset management business development of the firm. And the theme for today and this month is who's feeling liberated after, of course, a couple intense weeks after Liberation Day. Today with us here is Katalin Tischhauser, Sygnum's head of investment research. She's here to walk us through some of the biggest crypto market questions we're watching and seeing right now. As always, all content and opinions are presented in this live stream do not constitute any investment advice. So let's jump straight in and get going on topic number one, which we would like to call liberation, but at what price? We're seeing signs of liberation in the global economy, but what's the cost? Let's explore how deglobalisation is affecting risk assets and shaping the future of the crypto market. Katalin, to your mind, what's the probability and risk of a full-blown global trade war?
Well, there is already a trade war between the US and China. Whether this will, when we talk about 125, 145% tariffs, that basically prevents trade. Now, whether this is going to extend beyond the US and China, we'll have to see. The EU has been making some belligerent noises, so and also communicating with China on these topics to some extent. So we'll have to see what happens there. Generally, countries that are net exporters have to lose from a trade war, which is what the position most countries are in versus the US. I would expect that most countries will act rationally. But of course, we'll have to wait and see. But in any case, the main event really here is the US-China trade war, and that's already happening. And in many ways, this was quite inevitable because of the US's extreme dependence on China, which the US had to address at some point. Actually, the dependence cuts across so many critical industries. It's maybe in people's minds, it's more to do with plastic toys, but actually that's mostly not the case. Well, that is also the case, actually. So children will probably be very upset, but it's mostly not the case. In terms of the strategic importance. For example, if I can throw some numbers at 90 to 95% of the ibuprofen imported by the US comes from China, 70% of global paracetamol originates from China, 80% of the active ingredients in antibiotics, 80% of solar panels, 65% of lithium batteries, a lot of semiconductors, gunpowder, all sorts of things affecting also the defense industry, and maybe most critically the rare earth minerals, where China has an over 90% market share, and these are critical components in high tech and defense. So this dependence for the US was something they had to simply address at some point. There may be a second reason, that basically the rise of China in terms of purchasing power parity, the Chinese economy has overtaken the US economy more than 10 years ago now. And more recently, we have seen that China started competing in high-tech industries with the US. And I think that the US has also seen this, or is also seeing this as a threat to its hegemony, which was another reason they wanted to address the China dependence, and possibly a sort of function stacking, multiple objectives. I think these policies sounded very sensible, and they would satisfy multiple positive objectives, not just reducing the dependence on China, but also reshoring industry to the US, stimulating domestic demand, creating a surge in domestic production, encouraging companies relocate to the US. It's also revenue generation for the federal government, which is also quite welcome with the budget deficit, and also potentially to put pressure to encourage, let's say, the central bank to provide liquidity and cut rates. So it was something that was necessary and potentially made a lot of sense. I think the questions are around the execution and or maybe also some of the assumptions that the US administration has made. I think they made two key assumptions that didn't hold. And one is that, which is an assumption almost everybody made, is that generally the exporter has got to lose in a trade war. So the assumption was that China has the weak hand. And the other assumption was that aggressive tactics will make China back down. And actually, when the dependence is this great, I think China probably has the stronger hand here. It's kind of what people say: you owe the bank $100, you can't repay, you have a problem. You owe the bank $100 million and you can't repay, the bank has a problem. So I think it's the magnitudes are a little bit similar here. Because this degree of dependence, cutting off the China trade, is hurting the US more. And also in terms of the aggressive tactics, China has seen this coming, China has prepared, and they're not backing down. So this, coupled with the fact that the execution hasn't been, it seems like it hasn't been very well thought through in terms of the policy package of considering what problems this can cause in the US economy and how that can be prevented, addressed, managed, or bringing other elements of the policy, such as infrastructure, education, having the right skill sets for reshoring industry along. And I think basically the US administration lost quite a bit of credibility over the past week, both domestically and internationally, having to back down twice. First, when the Treasury markets reacted very negatively, and that caused a serious problem, and then backing down and putting in the 90-day pause. And then secondly, exempting about a quarter of China trade from the China tariffs because it's causing such great problems. Like it various, I think, we understand various industry leaders put a lot of pressure on the administration, such as Apple, where 80% of iPhones come from China, largely, or almost all the air conditioning equipment and so on. So there have been serious issues that affect certain products and industries, and then this pressure led to exempting quite a lot of things from the China trade. It's almost actually a quarter of the China trade. Yeah, so we'll see.
Yeah. No, of course, yeah, and this topic of deglobalization, and I want to say this all is accumulating currently in of course in a very accentuated way, but it has history, right? And the last decade has been shaped by deglobalizing acts such as Brexit. The US-China trade war started in 2018. COVID, with its supply chain disruptions in 2022, had also an impact and added to deglobalization, right? And you've mentioned a few impacts on businesses already, but what are some of the nuanced impacts that you see going forward in this deglobalizing world on especially economic growth, corporate profits, and the business models themselves?
Yeah, well, I mean, first of all, deglobalization is highly recessionary. It is for sure to lead to a global slowdown. Earnings forecasts have already been cut, and I'm pretty sure they will be cut some more. In terms of where this is all headed, once there is certainty, the world will adjust. Countries will adjust, companies will adjust. Countries that are quite self-sufficient because of their size can actually see a domestic revival and can be quite okay with isolationist economic policies. But that doesn't apply to most countries. Obviously, very few countries are self-sufficient for food and energy and so on. But the world will pretty much figure out how to work around it. I think it's the intervening period of prevailing uncertainty that is very difficult, but it's very likely that basically we're headed, or maybe we already are, in a multipolar world, and that unipolar moment is possibly over. So I mean, I think the most interesting question is how this will work out in the US, because the US could potentially be a huge beneficiary of these policies. And I think that will just come down. I mean, with a lag for sure, an adjustment is required, but that will just come down to the execution and the full policy package.
Right, exactly. And so turning that into markets and into like, you know, how markets will react. You know, what does it specifically mean for risk assets? You already mentioned, hey, short term probably not good, longer term probably better. But what's the impact for risk assets, and in particular for crypto going forward?
Yeah, well, I mean, first of all, you know, just to continue the point, the uncertainty is really bad for risk assets and for financial markets and for businesses and for economies. Nobody can plan. Investment is held back. 90 days is a very long time. That will mean a lot of withheld investment and kind of uncertainty that companies, businesses, also consumers will, and governments in terms of their economic policy will struggle to deal with. And I think it's also been quite dramatic how the treasury markets and the dollar reacted, which I think comes back to the execution. It seems like there's a Sell America trade on or kicked off, basically seeing the back dance and the policy package as not really credible. And you know, basically how the markets reacted has been how the treasury markets reacted has been extremely counterintuitive, because it happened simultaneously with very positive inflation numbers coming out. So that should say, okay, fine, the tariffs are going to be inflationary, but there is a lot more cushion there, because we are going into it with better inflation numbers. Also, we had the poor consumer sentiment numbers, which suggests recession, which suggests, you know, all of this should have meant a rally in treasury bonds, and we got the exact opposite, a massive sell-off. So this is putting a spanner in the works in terms of how things will work out for the markets and risk assets, and what policy decisions governments and central banks can make around this.
Right.
It's basically, the uncertainty is one of the worst things that we have been given recently, and it continues. It will continue for a while.
Right, exactly. And so that uncertainty, someone needs to address it, right? And so the tensions that we're seeing, like, there will have to be measurements taken, right? So what will be the impact of global liquidity and monetary policy actions?
Yeah. I think it's extremely likely that central banks will provide liquidity. It is for countries that are not imposing tariffs themselves, it is actually quite a straightforward decision, because the impact is purely recessionary. There is some inflation, possibly from supply chain disruptions and so on, but fundamentally, it's clearly a negative growth impact that most central banks will have to deal with. So I think there the liquidity provision is almost straightforward. And we have already seen even the Federal Reserve, one of the Federal Reserve presidents spoke last Friday, and the ECB making comments suggesting that they will definitely step in to stabilize financial markets, I think how it was put. But obviously, when we talk about financial markets, the central banks are not very concerned about risk assets, right? So a bear market in risk assets is not so much a problem, but a bear market in government bonds is a very serious problem, because governments around the world are so extremely indebted now. So, for example, in the case of the US, there's over $9 trillion of treasuries coming up for refinancing in this year. The US administration has repeatedly stated that they really want to manage the economy and see in a way that bond yields come down. So seeing a sharp rise in bond yields has definitely rang alarm bells, and I think it makes it quite likely, and comments have already been made to that extent, that even the Federal Reserve will take measures, and for other central banks, the equation is even more straightforward because there's less inflationary effect. For example, even though China imposed tariffs, right, on US exports, but China is a net exporter, and US imports into China are not a significant, they do not make a significant impact on Chinese inflation, for example. So most central banks have quite a lot of leeway to respond to this, and I think the US central bank will respond as well. We're actually going to see the ECB on Thursday, likely cutting rates. So
right, exactly. So interesting, super interesting dynamics going on, right? We'll see the ECB on Thursday, you mentioned, and we'll have an eye on these 9 trillion that are coming due of US debt for the rest of the year. And yeah, we'll continue following the market on that front very closely. I'd like to move on to the second topic of today's investment outlook, and that is Bitcoin's shifting correlation regime, right? So let's talk a bit about correlations in these volatile environments, right? Share with us your observations about crypto market correlations with risk assets.
Well, the way I would phrase it is crypto correlation, I think, is not what it seems. Bitcoin has been, and the whole crypto market, but also Bitcoin specifically, has been day-to-day highly correlated recently with risk assets. Of course, over the longer history of Bitcoin, sometimes the opposite was the case. Sometimes this has been the case. On average, the correlation hasn't been that high. But also, there is a difference between day-to-day trading moves, which are usually quite correlated, versus the net of investment moves that net out over time. If we zoom out a little bit in terms of the time horizon, we see that crypto and risk assets often, for example, over the past 6 months, move in opposite directions. And I think over time, the net investment that flows into Bitcoin specifically, especially investment that's seeking its more store of value, safe haven characteristics, it's slow moving, it's not liquid, it's not influencing prices on the margin as much as the trading flows, which are often quite highly correlated directionally with risk assets. There is also the question of what should it be fundamentally, and I think Bitcoin is fundamentally not a risk asset. There is some tech industry building on Bitcoin, but all the revenues from that are paid to miners, i.e. outside, they exit the system, which means that they don't contribute very much to Bitcoin's fundamental value. So anybody who assesses how much should Bitcoin be worth, it's primarily assessed on the basis of it providing a safe haven and store of value. And so in that fundamental sense, it obviously shouldn't correlate with the tech industries. I think the reason why it has and it does is that quite a lot of people trade Bitcoin as a proxy for the crypto market, and it's not really a proxy in the sense that the applications are mostly building on everything else other than Bitcoin. So Ethereum would be the best proxy for the crypto industry, and the crypto industry is a tech industry, and it should trade like tech industries trade, but that's happening away from Bitcoin. It is just that a lot of people who come into crypto often buy Bitcoin first, trade Bitcoin as basically their only crypto exposure. And especially recently, we have seen a lot of new money coming into crypto and then basically just treating Bitcoin as their crypto position.
Yeah. And so is that Bitcoin nuance? I mean, and if we look at markets, recent data shows Bitcoin's price has been holding relatively firm. It even gained a little bit in early April, right? While at the same time, equities dropped 10%, and then there was a new tariff announcement. Like, would you say there are early signs of a Bitcoin decoupling with respect to that?
Maybe. I mean, just quite recently, both Treasury Secretary Scott Bessent and BlackRock CEO Larry Fink came out and make some very strong statements of Bitcoin being a safe haven asset. Actually, Larry Fink went much further than that and said it could unseat the dollar as the global reserve currency. So I think these comments from influential people. And also a lot of expectation that this incoming money printing and the debasement of fiat currencies, a lot of people are advocating for holding Bitcoin for its disinflationary safe haven characteristics. So I think that is definitely happening, and it is what shows up in the net flows over the past 6 months, which have been actually uncorrelated over that longer period, directionally opposite to risk assets. And there is also, of course, the progress or lack thereof on the Bitcoin reserves. Now the progress at the US states seems to have slowed down quite a bit. It passes certain committee stages. I think there's like now 4 states where it passed the committee stage and is going for a floor vote. But so far, none of them have passed. Actually, 2 states have rejected it. And even states that where the bill passed, they took out the Bitcoin reserve provision, so they just left it with a sort of we're in favor of Bitcoin. Bitcoin is great, but the reserve provision was taken out of it. So it seems that kind of slowed down, and it's a bit of a chicken and egg, because obviously, if there is movement, and movement could come from as a US state passing the Bitcoin reserve bill, there's more than half of them put these bills forward. It could also come from the US federal government after establishing this Bitcoin reserve from the seized Bitcoin, if they start purchasing for that reserve, which they actually can. They have to be very careful how they do it, but they actually can. And they're apparently working on figuring out how they can do that. If there is movement, then that would also, of course, influence Bitcoin being traded more as a safe haven asset and less as a high beta risk asset. But it's a bit of a chicken and egg, because if Bitcoin hadn't traded in the last 2 months in such a correlated manner, that probably there would have been more progress on the US states passing the Bitcoin reserves. So the movement is in that direction. How fast, we'll have to see.
Right, exactly. And a few ifs that have to be answered, right, before we can make a super concrete statement. All right. Yeah. Well, let's move on to maybe topic number 3 and some hopefully silver linings with respect to positive crypto-specific news flow, right? Because in these current troubled and volatile times, I'm sure everybody appreciates some positive airdrop and some positive news. Tell us, Katalin, what are these and how should we look beyond the current market noise to focus on the potential that digital assets and crypto continues to hold?
Yeah, thank you. This is a very good point, because the crypto-specific fundamentals are extremely positive. So, aside from global macro uncertainty, which could also turn positive, of course, with liquidity provisions, then that immediately is quite positive for risk assets and all financial assets, to be honest. But the crypto-specific news has been so positive, and it's right now not in the prices because of the macro-related moves. For me, the progress on the US regulatory front with the SEC and the other regulatory agencies as well, the FDIC, FTC, but of course, most importantly, the SEC, exceeded my expectations, how fast they moved and how much they have done already. The new chairman has just been sworn in, and already under the interim chairman, I thought that at the very least they would wait for Paul Atkins's confirmation and swearing in and maybe be positive but not do very much, but they've done so much. All these lawsuits that have been dropped and investigations stopped, also making very strong statements on providing regulatory clarity and practical paths to compliance that's actually suited to the industry. And now more recently, the interim chairman also came out and said, we are here. It will take some time to figure out the comprehensive crypto regulation. There's a lot of things to think through, but we are here to help you right now. So we're happy to put temporary frameworks in place. He called it Band-Aids, and he invited the industry to come and say, what are there certain things we could do right here, right now that would allow you to, to continue working in a positive way, and for innovation to proceed, and for the industry to be able to plan and grow. There's also been the very first US crypto bill signed into law. It's just a small specific thing that it's striking down an IRS rule from the end of last year, which Congress and Senate voted through, and now the president signed it into law. It's actually the very first crypto legislation so far in the US. So we are seeing a lot of positive movement, and it's not in the crypto prices, but it's especially not in the prices of the so-called altcoins, which are actually the ones primarily affected by all these regulatory moves.
Right. Okay. Super interesting. And maybe linking these positive fundamental actions and news that are in the industry to the topic from the beginning of this webinar, deglobalization and the macro picture. Do you see it? I mean, is crypto a solution to deglobalization on that matter?
I mean, I'm sure there's a lot of marketing pitches along those lines. And, to some extent, I mean, obviously, first of all, a solution to deglobalization, that kind of a little bit assumes deglobalization is a problem, which, obviously the process, the adjustment, the uncertainty is a challenge. But I think, it's not necessarily a problem. But having said that, crypto can benefit from a deglobalized world in multiple ways. There are certain, situations, for example, as maybe trade and financial systems become more fragmented, and then there could be more demands for decentralized financial solutions, right, that are not tied to a single country's economic policy. There's obviously what we have already talked about, and it's the whole, what Scott Bessent, I think, also talks about, is the hedge against economic uncertainty. So in an environment of heightened uncertainty, safe haven assets, which Bitcoin is increasingly making its way to be regarded as one of them. But, we have seen what happened to the Swiss franc and the gold price. In this environment of uncertainty, of course, safe haven assets benefit. Also, deglobalization could mean that cross-border transactions become more restrictive. So crypto can facilitate seamless international transactions. So it can lead to demand for some of the services, for sure, that crypto can provide.
Okay, interesting. And as a technological development, it of course has a long term will have a positive impact on globalization, right? Maybe we'll address the fourth topic and address our last question. And the fourth topic would be the single token ETFs, and would like to close the discussion today with the question. You write in your investment outlook for April that you're skeptical on the demand for single token ETFs, right? And the question would be like, what's the reasoning behind that? Why are you so skeptical on that development front?
Well, I'm skeptical on the demand, yeah, and I have been for a long time, and I remain so. I think they're in no man's land. Anybody who wants to invest actively in the crypto market wants to have access to the whole market and will invest spot. Eventually, of course, for institutions, that requires adjustment to their systems, settlement, and risk management and so on, organizational adjustments, because it trades differently and in a different place. But fundamentally, anybody who's interested in active investing wants to avail themselves of the whole universe. And the alternative is to invest passively. And I think that passive crypto ETFs will eventually find a lot of demand in index, even eventually sector ETFs, maybe not quite yet. The use cases need to blossom a little more before the sectors become so prominent that, maybe DeFi is already there, or, one or two are getting there. But basically, passive investing is going to be a theme. But single token ETFs, they're not really passive, although currently Bitcoin is traded as a passive exposure to crypto. And I think even Ethereum is bought as traditional institutions purchasing Ethereum ETFs. I think it's done most on the basis of passive exposure to the crypto industry, to all the use cases and everything that's building in crypto, rather than expressing a view on Ether specifically, and it's, how is it doing with the L2 unifying liquidity and so on. I don't think it's on that level that these ETF purchases are made and are expressing a view. I think it's kind of a passive investment. So the Bitcoin and Ethereum ETFs actually provide passive vehicles, to be honest. But when we start issuing a lot of single token ETFs, then that no longer holds. And so, there will be some demand, but I don't think there will be a lot. And we already see actually some evidence of this, because a couple of ETFs were issued already in the last two weeks through backdoor without SEC approval, using various workarounds. And one was that after the CME created the Solana futures, the Solana futures ETFs were issued, and it was basically deemed that the CFTC can approve a futures ETF. And the Bitcoin and Ethereum futures ETFs were approved by the SEC. So I think this is, some sort of agreement behind the scenes that is now okay if it's a futures ETF, or if the underlier is not spot, then the SEC maybe doesn't have to be involved. This has not been stated publicly, but this is what has been happening. And we saw also one of two leveraged ETFs, one on the Solana futures and another one on XRP, leveraging existing ETP products on XRP, and again without SEC approval. So these products have already appeared in the market, and the demand for them is just in the single digit millions. I think the leveraged XRP is slightly above 10 million, but these are very, very small numbers. So the evidence also suggests that that there isn't really probably a lot of demand for the single token products. I think for now, BlackRock is holding seemingly the same view, because they're not applying to launch these kinds of ETFs. But on the positive side, what I would say is that the trajectory, also that these ETFs it was possible to issue them. The trajectory, I think, is clearly that I think it's almost certain that the SEC will authorize a whole host of crypto underlyings, and a lot of ETFs will be possible sometime this year. Maybe even June would be a surprise. I think that's when a lot of the deadlines, there is a deadline for a lot of these applications. It's not the final deadline. They can still postpone, but it could be that they will be so proactive as to actually approve quite a lot of applications, and that would open the way to crypto index ETF products and so on to be launched. And I would expect to see a lot of launches. And in net aggregate, especially when passive products also exist, in net aggregate also the demand to come for that.
Right, exactly. Interesting. So that trajectory seems very likely. We'll definitely have an eye on it. I'd like to wrap it up with that today, and it brings us to the end of today's live stream. Thanks everybody for joining today's super interesting session. Big thank you to Katalin for unpacking these important themes and these very, very volatile times. For a deep dive into this and other important topics driving the crypto market this year, download the April Investment Outlook and other research that we published there by Katalin. One of the interesting pieces that we recently published is which blockchains do actually make money, diving a little bit deeper into that. So you'll find that on the Sygnum website under the Learn section in Research and Education. Please also visit the Sygnum website and join our over 30,000 member community on LinkedIn to stay up to date on launches, news, and research. And with that, I'd like to close today. Thank everybody again, and looking forward to seeing you next month. Have a good one. Bye.